Hey guys, welcome back to another video today, and today I'm here to talk about 3 stocks that I think are going to make people a lot of money over the next 3 to 7 years, even longer, even shorter. I think you have to get in these stocks right now though before August, because in August I think it is going to start taking off, and maybe get into it in August, but very soon you should buy these stocks. So without further ado, if you do enjoy this video, be sure to like and also subscribe to the channel. I really appreciate you guys. We're at 211 subscribers as of recording this, on the way to 300. Thank you for watching. Let's get right into it. So great day in the portfolio again. We're at $24,187. This is an all-time high for the port. Very good. Been very fun investing journey. And the first stock we're going to talk about is Google. Ticker symbol for this one is GOOG, alphabet class C. We have Google just reported earnings, and they're actually up after earnings. Not by a lot, but they're up after earnings. And I've been saying I want to buy Google for a long time, and I finally started my position. I really believe in Google. I really like Google, and I think the main thing they have going for them is Waymo. So Google is very cheap as it is. They have an earning P ratio of 20. For a tech company, that's like nothing. This is a very cheap stock. They have a market cap of $2 trillion. I think very short lived. It's going to be $3 trillion in no time, and then 4, and then 5, and then 6, and 7, 8, 9, 10. But let's look at Waymo. So this is an article. Waymo is worth $5 trillion for Alphabet stock. That's not crazy. So this would take the stock to over $500 a share. That's not crazy either. I think this is going to happen, honestly. Waymo has grown the number of weekly paid rides from 10,000 to over 100,000 in the last 12 months. It went from 50,000 weekly rides to 100,000 just in the last 6 months. So, I mean, Waymo's growing very fast, and it's a very good business model. I really like the business model, and their competitors are non-existent. Even if competitors do start popping up, I think Waymo is so well established in this space that it's going to be pretty hard to take market share from them once the competitors do pop up. And I think Google has done a very good thing by creating this. And you can see at $30 per ride, if we're assuming that 200 million rides a week translates to $1 billion a month and over $10 billion a year, at $30 per ride, we're talking revenues of close to $300 billion per year. If you add $300 billion to Google's revenue, that's pretty good. So investors will soon recognize that the $300 billion revenue figure for the current ride-hailing market has substantial growth potential. It could easily expand by 2 to 3 times. A $1 trillion market for autonomous rides isn't out of the question. This growth would also translate to significant revenue opportunities for automakers like Tesla, which I've talked about in previous videos. And we can see returns for Google stock have been all over the place. 65%, negative 39%, and then up 59% again the next year. These are very volatile returns for this stock. But I think that Google, I mean, this is insane. This is a very good time to get into Google stock. So we can see right here, this is probably the part I like most about this article. If Waymo can capture about 1/3 of the $1 trillion autonomous rides market, which is easy, they're already most of it, so let's say more competitors come in, but Google still has 1/3. That's great. It could generate annual revenues of around $300 billion with a 50% margin. That's a neat $150 billion in profits. Their margins are going to be higher than 50% with autonomous driving. They don't have to pay like anything besides startup costs and maintenance, which is a little bit more than 50%. And what's that worth? At a 30 times earnings multiple, which is regular for Google, a 20 PE is very cheap for them. That would imply an additional valuation of about 4.5 trillion for Alphabet. Considering that Alphabet is worth roughly 2 trillion presently, this could take the market cap for the company to over 6.5 trillion or over $500 a share. I don't think this is crazy. It's not crazy at all. I love this take. I think it's very, it's very likely. So the P ratio is 20 right now. It's going to be 30. And their market cap is 2.35 trillion. I think that the market cap, it's gonna get higher. It is going to get higher. And I mean, look at Google. They're beating earnings every quarter. I mean, this is a company you want to get in. This is a great company. I don't really have much more to say for that. But also I did want to show this graph of average monthly stock market returns from 1980 to 2018. So if we look historically, August is a pretty flat month. It's negative, but 0.15%. That's pretty give or take as far as negative goes. It's not that far down. But we see September is usually negative 0.7, which is a little bit closer to a whole percentage point. So September is usually a pretty good drop in the stock market, and then October, November, and December, there's a very good rally that usually happens. So this is not indicative at all. This doesn't mean that it's guaranteed to happen, but I think that it is a pretty good estimate of what's going to happen in the stock market. And if you get in right now, I think you can dollar cost average down, and then October, November, December, you're going to be in for a fun ride. So the next stock I want to talk about that I hold in my portfolio, Cheesecake Factory. So Cheesecake Factory is a stock that's done me very well. I don't have a large amount of money in it, but I do have some Cheesecake Factory. I do want to get more in it. I do think that this company is going to be worth a lot more than, this measly $3 billion market cap at a 20 PE. Again, very similar to Google. Very undervalued stock right here, even though their price has gone up a lot in the past year, the past 5 years. They've been doing pretty good. But we can see also this company pays almost a 2% dividend, which doesn't hurt. I appreciate the dividend. It definitely helps out a lot. But with Cheesecake Factory, what we're looking at isn't Cheesecake Factory. So that might sound a little confusing. But we're not looking at Cheesecake Factory. We're looking at North Italia and Flower Child. Two high-performing demographic diversified concepts acquired through the Fox restaurant concepts. So Cheesecake Factory is Cheesecake Factory itself. We know that. But they also own other restaurants, which they acquired through buying the Fox Restaurant Concept Group, which has a lot of other restaurants. But there's been some very successful concepts like North Italia and Flower Child. And these are starting to take off. I think a lot of people don't realize this right now. But you can see Cake is currently valued. This was made a little long ago, so Cake's gone up a little bit. But forward P of 13 and a trailing P of 15. So the balance sheet is solid with manageable debt and clear path forward. 20 new restaurants are expected in 2025, many linked to these high growth brands. I mean, that's free money, right? The market is still valuing Cake based on its past identity, ignoring the strategic shifts and solid financials that now define the business. So Cake is one of the most undervalued stocks in the stock market, in my opinion. I think you could scatter the whole market or scour the whole market. Look at everything. Cake is one of the cheapest stocks in comparison to how much value this company has, because their ticker symbol is Cake. They're called Cheesecake Factory. No one's looking deeper than that. That's all that people are looking at. They're not looking at Flower Child. They're not looking at North Italia, which are two very high profit businesses, ones that have been doing very good for this company. Look at the North Italia specializes in Italian cuisine. There's other FRC concepts. The Flower Child brand. The numbers on Flower Child and North Italia are insane as well. Cheesecake Factory isn't losing money as Cheesecake Factory. They're a cash cow. They're still doing what they do best, but they're adding these other companies that are doing even better, and they're growing faster and faster. And you have two of them along with a very successful one, and then you have more concepts that are coming in, over and over again, and some of them are sticking. They're opening more locations for certain concepts as well. There's one called Zinburger, which they have a few locations of. There's a few pizza places, and they're multiplying the number of locations that they have. So Cheesecake Factory has all of this cash on hand, and they're just reinvesting it. And the ROI on their investments, their compounding annual growth rate is, it's you can't find it in the stock market. It's above 50, let's say that. It's very good. So when they make these investments with this large sum of money to open a new restaurant, open a new Flower Child, open a new North Italia, their returns are pretty damn good. So I'd say get into Cheesecake Factory right now while you can. It's very cheap right now. I don't think it's going to be this cheap for much longer. So I would get into Cheesecake Factory right now. I just want to say that. So even if it does go down, you can dollar cost average, but I think it's going to go up. So yeah, I'd get into that. The third and final stock on this list, last but certainly not least, maybe least in price, not least in value, we have Honest. So ticker symbol HNST. The Honest Company is a company that specializes in body care per se. cosmetics, but they make a lot of baby products. So products for your infant. They make diapers, wipes, and then they also are starting to do some skincare, which I don't hate. I do think that that's a great thing to add on to the company. But if we look at their stock right here, we can see their CEO, Carla B. Vernon, actually used to work at Amazon pretty high up, so she knows what she's doing. But they have 164 employees, not too many. They don't have a lot of people on payroll, which I like, for especially for a company of this size. They only have $551 million market cap. Very small company. So this is a risky investment, I will say. Cheesecake Factory is a no-brainer. Google is a no-brainer times two. But the Honest Company is a risky investment, I will say, because there is a chance that this company could go bankrupt. I don't think that's going to happen, but there is a chance because of this company being so cheap. So once they do stabilize themselves as a company that's going to remain profitable, their price is going to skyrocket. So you have to get in before that. This is the risk you have to take. So Honest, you can see their price has been all over the place. They actually IPO'd in 2021, so they haven't even been public for 5 years. But they IPO'd at $21, dropped all the way down to $1, rose all the way back up to $8, and now they're kind of flattening out at around $5. So I do want a lot more shares of Honest. I don't have that much money in there. I need a lot more, but I really like Honest. I mean, there's a little article right here, also by Yahoo Finance, overviewing the cosmetics industry. According to the Grandview Research, the global cosmetics industry has a market size of around 300 billion as of 2023, and it is expected to grow at a compound annual growth rate of 6.1% between 2024 and 2030. I don't hate that. I think that this is a great. It doesn't really talk that much about Honest. I read this before the video, but it is good that Honest is getting more press and more people are talking about it. Because all I have to say about it is that it's a great investment and that they're very cheap. This is a cheap stock you want to get into right now. I've made other videos about Honest, but I'd compare them to Procter and Gamble. Procter and Gamble is a little bit of a bigger company, just a little bit. But I think they can get there one day, and if not all the way there, then I think they're gonna get, close to it, or even if they get halfway there, even if they just do a tenth of what Procter and Gamble has done, you're 50xing your money. If they do a tenth, I think they're gonna do more than that. So, I really do like Honest. I think that their brand name is Honest. It's great branding. But they're saying that all their products are honest. They have honest ingredients. They list everything. I really like, because as people are becoming more aware about health as time goes on, it seems like more people are buying these more expensive items, but the ones that are healthier, and that's what Honest specializes in. So I really don't hate that. So yeah, guys, the 3 stocks we went over today: Google, Cheesecake Factory, and Honest. I love all 3 of them the same. I think that it goes in order from the least risky investment to most risky, but also lowest reward to highest reward. So yeah, if you guys did enjoy this video, be sure to like it. Also subscribe to the channel. If you do want to see more videos, you know where to find them. Comment down below what other kind of videos you guys want to see. Today it was my 3 best stocks to invest in before August, but I'm open to any ideas. Thank you for watching. I'll catch you in the next one. Peace.